When implementing our business strategy focused on customer centricity and risk management, we need to look at several concepts that facilitate the realization of our ideas. And you can already imagine that our platform, Q-Lana, is ideally positioned to support these concepts. For this block, we have identified two of them, which we like to present more in detail. Those are the definition of a specific risk appetite and of developing an approach to relationship pricing. Both of them are based on the calculation of a risk-adjusted return on capital, or RAROC, which we will present first. If introduced well, these two concepts allow a far accelerated approval and disbursement process. For example, with the definition of a risk appetite for an individual client, we can already pre-approve risk exposure even before they are brought to the necessary decision authorities. With relationship pricing, we have an enhanced transparency about the overall economic aspects of a relationship, allowing us to flexibly react to specific customer demands or also to aggressive offers from competitors trying to poach our established client base. We have split this chapter into two videos. The first one introduces the basic theory leading to the components of the RAROC, before the second one goes deeper into the explanation of the two concepts. My name is Christian Rummer. I am the CEO and founding partner of Q-Lana. We have developed a low-code based open banking and digital lending and asset management platform. Our banking platform is used by multiple financial institutions in lower and middle income countries and by asset managers around the world. In our blog, we will share with you our expertise and ideas about how to organize financial services, how to develop a successful business model for the next decades, how to manage risks, and how to implement all these ideas and concepts at the right speed and sequence. So let's start with the basic approach. We will give you a simplified explanation to quantify credit risk. We use three variables called the probability of default, abbreviated PD, the loss given default, abbreviated LGD, and the exposure at default, which is abbreviated with EAD. These three factors allow us to quantify the expected loss, or EL, of a loan exposure. We can use this result to support our pricing and to derive the amount of equity capital that is required to support the loan exposure. The expression to remember here is the unexpected loss. This relationship opens the door to the RAROC for many more calculations. The probability of default represents the likelihood that a counterparty will default, usually within a 1-year time frame. This is expressed in percentage terms. For example, a 5% probability of default assumes that there's a 5% chance that a specific loan will default within the next 12 months. You can also look at a portfolio of 20 similar loans, which have a probability of default of 5%. In such a portfolio, we expect one of those 20 loans to default within the next 12 months. How did we get to the 5% number? We used the rating models that we've introduced 2 chapters ago. The specific methodology to scale the ratings is something that we will explain in a separate training video. The second variable is the loss given default, which we use as a proxy to calculate the amount recovered by the lender from selling the underlying asset after default. Here we are asking how much money is the bank losing in case of a loan default. And a key factor for the assessment of this amount is the availability of the collateral for a transaction and the ability to liquidate that collateral. We will also discuss in a separate training video how to assess the loss given default, but in brief terms, it is driven by the historical experience the financial institution has had with loan defaults. The third variable is the exposure at default. The EAD refers to the expected loan amount outstanding at the time of the default. This requires an assessment of the time at which the loan will default, meaning when in the life of the loan the default will occur. The EAD also depends on the nature of the product. For example, a credit line is most likely used fully at the time of default, whereas a term loan has probably already seen some amortization occurring before the default. These three factors, PD, LGD and EAD, can be combined to a formula to calculate the expected loss. As the word says, this is the amount that is expected to be lost. And as it is expected, it's not really risk. It can be understood as the cost of doing business. It's comparable to an insurance premium, which in an ideal situation equals the actual losses a financial institution experiences over a period of time. The expected loss can actually be used in the pricing, as it is the charge a client needs to pay for the coverage of credit risk. The expected loss is also important in the modeling of credit risk, in which the information is used to derive the unexpected loss, which is the basis for the calculation of the required equity coverage of credit risk exposure. Before we get to the unexpected loss, however, let's have a look at a sample portfolio and conduct a couple of sample calculations. For our calculation, let's assume that we have a bank with a portfolio of 100 similar loans. All these loans are linear amortizing 4-year loans with an average loan amount of $10,000. This means that these loans reduce their outstanding amount in a linear manner. For example, for simplicity, we assume that 1 year after the disbursement of the loan, 75% of the loan are still outstanding, and after 3 years, 25% of the loan are still outstanding. Based on the assessment of the financial institution, it is likely that the loan defaults halfway through their life, with an estimated remaining exposure at default of 50%. We have also made an assessment of the value of the collateral and derived that this is on average $3,000. This means that considering an exposure of $5,000 and a collateral value of $3,000, in the case of a default, an average loan loses about $2,000 or 40% of its outstanding loan amount. Let's use this data for some exercise and let's answer the following 6 questions. The first question is, what is the expected loss of an individual loan? Here we look at the loan amount of $10,000 and consider the probability of default, the loss given default and the exposure of default. The calculation is $10,000 times 5% for the PD, times 50% for the EAD, and times 40% for the LGD, equaling $100. This means that we expect that we are losing $100 for each loan. Our second question here is, what is the loss if one loan actually defaults? The difference between the first and the second question is that we're no longer looking at the probability of a default, but we have an actual default. If a loan of $10,000 of original amount is defaulting, there is a $5,000 or 50% outstanding loan amount, and the recovery is $3,000. So our loss is actually $2,000. The third question is, what is the expected loss of the total portfolio? The expected loss of an individual loan was calculated at $100, and we have a total of 100 loans. Therefore, the expected loss of the total portfolio is $10,000. Here, again, let's differentiate between the expected loss and the realized loss. While we calculate an expected loss of $100 for each loan, this number is most likely wrong in all cases. Most loans will repay, in which case the actual loss is 0. And a few loans will default, in which case the actual loss is $2,000. Across the entire portfolio, our expected loss is correct. Broken down to individual cases, the expected loss is wrong in all cases. Let's get to the question number 4. How many loans are expected to default and what is the actual loss in that scenario? We are expecting a 5% default ratio and we have 100 loans in our portfolio. This means that we are expecting on average 5 loans per year to default. How much are we losing in this case? Well, the loss in each of these cases is $2,000 times 5 equals $10,000. And there is no surprise that the actual loss in the case of 5 loans defaulting, is equal to the expected loss, which we calculated in the question before. Moving on to the 5th question. What is the actual loss if 4% of the loans default? Remember, we only have an expectation about losses. The probability of default was supposed to be 5%, but that doesn't mean that every year 5 loans will default. We will experience years in which fewer defaults will occur and years in which we have more than 5 loans defaulting. If indeed we experience a 4% default ratio, we will have an actual loss of 4 times $2,000 or $8,000. If the institution has done its calculation correctly, we will have provisioned $10,000. This means that there is a profit in the institution of $2,000. Please be aware that in this example, we do not look at the specific accounting rules such as IFRS 9, but we just look at the economic aspects of this example. We have, however, the additional question of whether those $2,000 are really profit or should be considered a reserve. I would vote that this is a reserve, but in reality, bankers don't look at statistics. They consider themselves geniuses and think that they deserve the $2,000 as a bonus for their great work. That brings us to the last question. What is the actual loss if 6% of the loans default? The answer is that in that case of 6 loans defaulting, the actual loss is $12,000 or $2,000 more than our provision. How are we covering for this loss? Especially since in the year before we distributed the excess reserves as a bonus. Well, the only source we can use to cover these additional unexpected losses is equity. This gets us right to the calculation of the unexpected loss. So far, we've only looked at 1 year. If we simulate, let's say, 1,000 years, for example, through a Monte Carlo simulation and assess how many loans in each of these years default, we will find a distribution similar to the one on the screen. In the most likely scenario, we will lose 5%, but there will be individual years in which we lose less, or in many cases we lose more than 5% assumed. The distribution of these losses is skewed due to the limited upside but the significant downside, meaning in the best case that could happen to us, we have no loan defaults, 5 less than expected. But the downside or the worst case scenario could be that up to 100 loans default. In the distribution seen on the screen, we have experienced 2 years in which 13 loans defaulted. Aggregating this expectation to a model, we can see that the unexpected loss is calculated as the standard deviation of the mean for the defaults using a specific confidence level. If the expression of confidence level is no longer present in your brain from your middle school statistic classes, don't worry, we will have separate trainings for that. In brief terms though, the confidence level defines the overall size of the unexpected losses, and by that, in terms of banking, the amount of equity capital an institution needs to have to prevent its own default. If the unexpected loss exceeds the confidence level, the institution will experience a default on its own. In summary, we now have learned how we can derive the amount of capital that the institution needs to provide to cover for the credit risk it is assuming in its loan portfolio. This serves us as a quantification of the credit risk. We can take this concept and apply specific formulas which have been developed to calculate the amount of capital a financial institution needs to provide for specific loans. We cover the background of those formulas in separate trainings, but for now, let's just use an example. If we apply these formulas that are similar to those that are derived from regulations such as the Basel Risk Framework, our $10,000 loan, which we used in our example, requires a total amount of equity capital of $1,066.49. We have used the 5% probability of default, the 40% loss given default, and our loan has a 4-year maturity. We further use a confidence level of 99.9%, meaning that we like to have enough capital that our institution in theory only defaults once every 1,000 years. As a result, we can calculate the unexpected loss of $966.46 and an expected loss of $100. The unexpected loss we can also interpret as the economic capital. With this initial introduction, we take a break and we will continue in the next video where we will take these findings to explain the risk-adjusted return on capital and the concepts of risk appetite and relationship pricing. See you in the next video.